Hello, I'm Jeffrey Ham, equity analyst for Briefing.com. Today is Monday, January 5th. Stocks ended a choppy session of listless trading markedly lower as investors failed to build on the prior week's gains. The major indices struggled to put together a sustainable advance for the entire session. Last week, stocks advanced nearly 7%, but the advance came amid low trading volume. That had many wondering if participation would pick up and traders would show increased conviction now that the holidays have passed. Trading volume remained relatively low, however. Only 1.3 billion shares traded hands on the New York Stock Exchange. Though participation wasn't what many expected, there were still plenty of headlines to trade around. Pfizer made news when Financial Times reported the company is willing to acquire a large rival to improve its financial health. Pfizer indicated its goal is to increase revenue, which will come under pressure from generic drugs when Pfizer's patents expire. Despite the prospect of a mega merger, the healthcare sector finished 0.9% lower. Healthcare is the second largest economic sector in the S&P 500. The largest economic sector, technology, showed modest weakness. Apple provided it leadership after Chief Executive Steve Jobs issued a statement that helped put to rest concerns regarding his health. Financials traded as laggards for the entire session before finishing 2.5% lower. Citigroup and JPMorgan Chase had their estimates cut. Energy logged the best performance of the session, thanks to a 4.4% advance in crude oil futures. Oil closed near $48.40 per barrel. Crude was up 6.3% at its session high. Retailers registered strong gains as well, though consumer spending remains challenged. Such challenges underpinned Target reductions for Macy's and Target. Meanwhile, shares of Best Buy and Amazon.com were upgraded given their positioning in the current environment. No doubt, though, conditions remain tough for automakers. Ford and General Motors reported December sales dropped 32.4% year-over-year and 31.4% year-over-year, respectively. Ford's results were in line with the consensus forecast, yet GM's weren't as bad as feared. Ford and GM have seen their troubles exacerbated by stiff overseas competition. Still, foreign automakers aren't immune to the troubles of the global economy. Toyota Motor posted a 36.7% year-over-year drop in December sales. In other news, President-elect Obama is putting together $300 billion in tax cuts for individuals and businesses, according to the Wall Street Journal. The tax cuts would likely come as part of a larger plan that would include improving infrastructure. Total construction spending fell 0.6% in December, which isn't as bad as the 1.4% drop that was widely expected. Still, larger drops in spending are likely for December and the subsequent months. Despite the weakness exhibited by U.S. stocks, the U.S. dollar showed strength, reflecting foreign interest in the U.S. currency, if not in U.S. stocks. I'm Jeffrey Ham for Briefing.com, and thanks for listening.